Most people hear the words yield curve and think recession signal, but that is only one use of it. The deeper truth is bigger. The yield curve is the machine Wall Street uses to answer one question over and over again. What is $1 in the future worth today? Using a simple annual discounting approximation with a 4.38% 10-year rate, $1 10 years from now is worth about 65 cents today. Push that rate up by just 1 percentage point, and it falls to about 59 cents. That looks tiny, until you realize the same calculation is being applied to bonds, swaps, mortgages, pensions, private equity valuations, and trillions of dollars of derivatives every day. A yield curve can be used to talk about recessions, but before it can signal anything, it has a much more basic job. It tells the market how to price time. A 1-month dollar is not priced the same as a 2-year dollar. A 5-year dollar is not priced like a 30-year dollar. The curve is a map from maturity to discount rate. Once you have that map, every future cash flow can be pulled backward into the present. Here is a real curve. On May 8, 2026, the U.S. Treasury daily par yield curve showed 1 year at 3.75%, 2-year at 3.90%, 5-year at 4.02%, 10-year at 4.38%, and 30-year at 4.95%. These are not random numbers. Treasury explains that the curve is based on market bid prices and quotations for Treasury securities. So the curve is a daily snapshot of the market price of time. The cleanest way to understand the curve is with zero-coupon bonds. A zero-coupon bond has only one cash flow: pay today, receive par at maturity. If a 1-year zero bond pays $100 next year and costs $96.39 today, the market is saying that $100 1 year from now is worth $96.39 today. Do that for every maturity, and you have a discount curve. That curve is the skeleton under almost every rate-sensitive asset. Real markets do not always hand you perfect zero-coupon bonds at every maturity, and Treasury publishes par yields rather than a full official zero-coupon curve. So desks bootstrap. They start with the shortest maturity, solve the first discount factor, then use that answer to solve the next one, and keep stepping outward. In a simplified annual coupon example, using the Treasury par curve, the 1-year discount factor is about 0.9639, the 2-year discount factor is about 0.9263, and the 5-year discount factor is about 0.8208. Translation: $100 in 5 years is worth about $82 today, before adding credit risk, liquidity risk, or option risk. Once you have discount factors, you can derive forward rates. A spot rate tells you the price of money from today to a future date. A forward rate tells you the implied price of money between two future dates. In our simplified curve, the 1-year forward rate from year 1 to year 2 is about 4.06%. The 1-year forward from year 2 to year 3 is about 3.96%. And the 2-year forward from year 3 to year 5 is about 4.19%. This is why the curve is not just one line. It is a whole set of implied future prices. Now, we can price a bond. Imagine a 5-year bond with a $100 face value and a 4% annual coupon. The mistake is to think of it as one thing. Mathematically, it is 5 separate cash flows: $4 in year 1, $4 in year 2, $4 in year 3, $4 in year 4, and $104 in year 5. Discount each one by the curve, add them up, and the price is about $99.91. Not because of magic, because the curve told each future dollar how much it is worth today. A swap sounds more complex, but the core question is the same. One side pays fixed cash flows, the other side pays floating cash flows. The market asks, what fixed rate makes the present value of both legs equal? That is why discount curves and forward curves are infrastructure, not trivia. On a net-net basis, BIS reported that over-the-counter interest rate derivatives notional turnover averaged about $7.9 trillion per day in April 2025. Notional turnover is not the same as risk exposure, but it tells you the scale of the machine being used to price and hedge interest rates. The same logic keeps reappearing. A mortgage is not just one loan. It is a stream of payments with prepayment risk layered on top. A corporate bond starts with the risk-free curve and adds credit spread. A discounted cash flow valuation starts with future cash flows and asks what rate should bring them back to today. The curve is the base layer. Then the market adds spreads: credit risk, liquidity risk, inflation risk, optionality, and uncertainty. An upward-sloping curve says longer-dated dollars are being discounted at higher rates than short-dated dollars. A flat curve says the market is pricing time more uniformly. An inverted curve says short money is expensive relative to long money. Yes, that can matter for the economy. But even before any recession story, it changes asset prices. It changes which cash flows matter most. It changes swap rates, mortgage rates, pension liabilities, and valuation multiples. There is one important caveat. In real finance, there is no single universal yield curve. Treasuries have a curve. SOFR has a curve. Corporate bonds have credit curves. Mortgages have option-adjusted spreads because borrowers can refinance. Equities use discount rates that include risk premiums. And forward rates are not guaranteed forecasts. They are market-implied prices under today's assumptions. The simplified model is not the whole trading system. It is the core engine inside it. So the next time you see the yield curve in a headline, do not only ask whether it predicts a recession. Ask the deeper question: what is it doing to the price of every future dollar? Because that is the real job of the curve. It maps time into money. And when that map moves, every long-dated cash flow in the financial system gets repriced.